Hi, good afternoon, everyone. I'm Kimberly Fulham, the Home Program Manager at Pennsylvania DCED. I just wanted to say good afternoon. Thank you so very much for taking time to participate in DCED's Determining Income training. This training has taken quite some time to develop. That's because we wanted to make sure that we were providing some sound, solid guidance for all of you. This was the training that was originally supposed to be in-person training in March, but then of course, as we all know, COVID hit. Some of the updates to the training occurred because of COVID, and those related matters will be covered in the upcoming training. And today we're going to be starting with the first training event out of 5-part series. And I just wanted to give you a little reminder and encouragement to go ahead and sign on for register for any of the remaining sessions if you haven't done so. Our presenter for today and for the whole entire series is Shauna LaRue-Morai, and she is a principal with ICF, a national technical assistance provider to cities, counties, and states, as well as HUD. She has over 20 years of professional in several HUD programs, including Home, Neighborhood Stabilization Program, the Community Development Block Grant Program, and Disaster Recovery. Prior to her ICF career, Shauna worked for Bergen County, New Jersey, low-income housing tax credits developer, the National Association for County and Community Economic Development, National League of Cities, and at HUD headquarters under the Washington Leadership Program as part of Indiana University School of Public and Environmental Affairs. Some fun stuff about Shauna. Income eligibility is literally her favorite topic, so we're fortunate, aren't we? She can recite the income regulations in her sleep, and she has worked in your shoes. She also lives conveniently just across the border into Ohio State and knows a lot about Pennsylvania because she enjoys our theme parks, our food varieties, etc. So you just heard that she went to Indiana University, which is actually in Indiana for her undergrad. However, she also knows that your first thought was probably Indiana University of Pennsylvania, IUP. And on that note, I'm going to turn it over and say, hello, Shauna.
Hello, thank you so much, Kimberly. I appreciate that warm introduction, and welcome everyone to the first in the webinar series on determining income. We will be joined, besides Kimberly, will also be joined by others from DCED, and please know that this is a safe place. So we want you to ask questions, things like that as we go through. You should have received this morning a Google Docs email that provides the material. So hopefully you have received that. It's PowerPoints as well as a technical assistance manual. And in terms of WebEx, a couple of things. So if you have a question that you would like maybe a clarification on something that I said or a question about the material, please use the questions box. You'll see the questions box in the, at least on my screen, the lower right-hand corner. Just click on the Q&A and type your response. If you are having technical issues, I am joined today by Chantel Key from ICF, and she will help you with any sort of technical issues in the chat box. So you should use that if you have any sort of audio issues or if you need anything related to the training. So just want to make sure that we say that. This webinar series is going to go over the course of 3 weeks. We will be together, so this won't be your only opportunity to ask questions. So today I'm going to go through an introduction to the webinar series. I'm going to talk about income basics and generally how do you determine income. And we're going to save for next week the specific definitions of income. So Part 5, or the Section 8 definition, is a very common definition. The majority of you are probably using it. And then we'll also talk about the Internal Revenue Service, like the IRS definition. That is what maybe some of you are using for some pieces of your DCED grants. And then the following day, we'll do an office hour just to talk specifically about those definitions. And then we will get back together the following week to do sessions 4 and 5. So we will be doing adjusted income and tenant-based rental assistance. That is for those of you that are running a tenant-based rental assistance program with your home funds. You'll need to attend that session. And then finally, we will, the bookend to this is session 5, we'll go over overall income policies and procedures, record-keeping resources, and conclusion. And so if you are using your DCED grant for maybe a home ownership program or owner-occupied rehabilitation or rental, you definitely need to make sure that you attend not just today, but you want sessions 2 and 3, and then definitely session 5. So if you're not registered, the link that you received with the materials this morning also includes registration for future sessions. Make sure you're signed up. And Chantel Key, as I mentioned, who's with me today, she sent all of the registration links. So please feel free to register for additional sessions. We would love to have you at each and every one of these. So hopefully you know that maybe from looking at the material that we are going to use a polling software. This is to keep us all engaged. It's to gather some feedback from you, lots of fun questions. So want to make sure that you either use your smartphone, which I realize in the graphic that looks like a really old iPhone, maybe a version 4 or something like that. You can also open up a browser on your desktop or on your laptop and just a separate browser and put in menti.com. So I'm going to go ahead and start Mentimeter because I do want to ask a couple of questions right as we get started. So just 1 second and I will grab the Mentimeter. Okay, great. So we want to make sure that you can get into Mentimeter. So we want to make sure that you can see my screen and also type in the code. So again, if you'll just go to menti.com, that's just MINTI.com, and you have the code here, which is 488381, and go ahead and make sure that you can get into the Mentimeter. And we'll be using Mentimeter throughout the whole session. We want to make sure that, again, we keep this engaged. So, so just make sure that we know that people can join. Okay, so here's our first kind of icebreaker. We want you to vote for your favorite Pennsylvania park. So as you're logging in, want to make sure that you vote whether or not you like the Kennywood amusement park or whether or not you're more of a Hershey Park fan. So please vote now and then we'll see who the winner is. So I've been to Kennywood. One of my best friends grew up in Pennsylvania, right outside of Pittsburgh and Monroeville, and we went to Kennywood one year for Halloween. I've also been to Hershey Park. More recently, I was there just over the Christmas holiday in December before everyone stopped doing some travel. So I was just there, saw the refurbished ride that is there. I guess it's been refurbished lately. So let's see who the winner is. We've got 90 people who have already voted. I think there's about 140 of you, if I remember correctly. So let's see who gets the winner today. Okay, and hopefully all of you are having good luck with Mentimeter, either on your desktop or on your smartphone or iPad or whatever you have beside you. And we will be asking probably 4 to 6 questions per training as we go through this webinar series. So we want to make sure that you have something that's available. So even if you don't have something today, it's totally fine. But we do want to make sure that we're using it. So, okay, so I think everyone's sort of caught up. So I'm just going to go ahead and hit enter. If you haven't provided the vote, you can still vote. So everyone's on pins and needles, right? Hershey Park. All right. Great. Well, thanks so much for that. Again, if you haven't voted, you can still vote here shortly. So both great parks. You guys have a lot of fun things to do in Pennsylvania. So we'll go ahead and move on to the next question. Or I want to move on to the next question. Okay, so we will save the next question because I am not seeing. I'll stop sharing here for a second to figure out what's going on with Mentimeter. I'll go ahead and roll into the materials. I'll save my second question I was going to ask together. We'll do it a little bit later. I think Mentimeter just got frozen. Okay, so why we're here today. So we're going to talk about just the basics in terms of income determination. So, we know that most of the people that are served in home and CDBG programs must benefit low-income individuals. So we're talking about those that are 80% or less of area median income. And we do have deeper targeting. If you're doing home rental, there's some deeper targeting requirements, which I'll talk about later, as well as tenant-based rental assistance or TBRA. And income eligibility is something that's like the main tenet of all of the programs that we work on. So we're talking about tenants that are served, homeowners that are served, home buyers, and you do have to document that they've been income qualified prior to providing assistance. So we're going to talk again next week about like the different income definitions, but Part 5 in IRS, you need to make sure that you've made a decision about one of those for your program, and you're going to codify those in your policies and procedures. And then also, depending upon how you run your program, you may have written agreements with others who are administering a grant for you to tell them which definition to use. Basically, HUD would say that if you do not have any income documentation, then your project is not compliant, and you may owe funds back to HUD or to DCED, depending upon the situation. So this is like really an important topic. I'm glad there's so many of you here who obviously work very hard to document income eligibility. So we put together this chart wanting to make sure that because I'm talking about both home and CDBG, you folks probably know that there are different terms that are used. For the majority of DCED's programs, they've decided that they are going to be using more of the home specific income requirements. There's a few places where CDBG is different, and I'm going to do my best to point those out. They're also covered in the TA manual as well. But moderate income is something that is used strictly in the Community Development Block Grant Program. It is the same as low income for the home program. It's just when we talk about CDBG, it's combined into low and moderate income, or LMI. Very low income is somebody at 50% of area median income, and for CDBG that's the same, and then extremely low income is for those that are at 30% or less of area median income. I haven't said this yet today. We're going to talk about income limits throughout the training, but the income limits are going to be going into effect on July 1st. There will be a listserv message that goes out from the HUD Exchange. We're just doing some final touches. So 2 weeks notice here, and you guys will see those today if you're on the HUD Exchange listserv. So what are we talking about? So the majority of this training is going to be on annual, also known as gross income. And that is the maximum in terms of its gross wages, gross amount of Social Security. All those things are used to determine what annual income is. And it's used for, is my client who's applying to me, are they eligible for my program? And that's like the first step. And again, there are two definitions. There is something called adjusted income, but that's used in tenant-based rental assistance. And tenant-based rental assistance, as I said, will be covered in a future session. But there are certain deductions that are taken off for an elderly household, a disabled household, et cetera. So we also thought it would be helpful to provide a handy chart here about the primary differences. I just want to make sure that those of you that are coming to adjusted income know that we're going to talk about adjustments to income or deductions, and then we're also going to talk about tenant-based rental assistance. Most of the programs that we work on, home buyer, owner-occupied rehabilitation, rental, we are strictly talking about annual income only, and that's going to be the majority of the presentation over the next couple of weeks. So I think you know, and I saw the list in terms of the attendees. You know, we have a lot of you that are grantee staff who are receiving funds directly from DCED, but you may also have some subrecipients or those that work for community action agencies, I noticed. You might also be a community housing development organization or a CHODO that receives home funds. And then finally, we could have some rental property owners and managers who are on the call as well. And so everyone needs to know about determining income. It's not just, you know, one person's job, it's everyone's job. So we thought it'd be helpful to kind of talk about sort of like income eligibility as a process. So there are really four steps in that process, and we'll talk about each of these. So the first one is to collect documentation. The second step is to really calculate income eligibility. Step 3 is about comparing income eligibility to the income limit. And then finally, document the files. So for each of these, there's a few steps that are included. So the first step is the application and to collect information about that household. So a couple things in terms of what makes a good application, and this is the first time that you're going to be working with your client, it needs to be good. So it needs to ask about all household members, including ages. We need to know about ages because we need to know who is age 18 and older, particularly for the Part 5 definition. We also need to make sure that we have a section in there that talks about what income and asset sources the household receives. And then we also need a section that says at the bottom, you know, I hereby swear everything is true and accurate to the best of my ability under perjury of law. Basically, I call that the signed declaration language, okay? We also need a release from the household if I'm using like a third party. So if you use like a verification of employment, or you have your clients that you're working with use any type of third-party form to Social Security, to the unemployment office, any of those things, you have to have them sign a release. And then what is optional is to do some type of sworn income and asset statement. There's a sample in the TA manual, but sometimes people like to have the household sign off that these are my income and asset sources, so that it provides extra security. And then good applications also include questions about raises or any type of anticipated income changes. So as Kimberly mentioned, we are fortunate or unfortunate to talk about COVID, but we did make some changes to the slides, so I'll try to point those out. So DCED received, HUD accepted their request to do any type of new rental or tenant-based rental assistance clients that you do not have to collect source documentation April 30th through December 31st of 2020. So that time frame, you're not required to collect that source documentation. A lot of people are doing like virtual applications, just trying to collect some information, but documentation then would be due then after that date, which is approximately 90 days. So in Pennsylvania, that is a specific requirement. If you happen to work in multiple states, which I'm not sure if you guys do, but in case somebody, you know, kind of is across lines here, maybe a consultant, that's just DCED. Okay, so step 2 then is we're going to calculate income eligibility. So we're going to use one of the two definitions. We are projecting income forward for 12 months. So it's really a snapshot of that household. And that snapshot is good for 6 months. And we will talk later about the timing of income eligibility, but we want to make sure we're projecting forward for 12 months and we've got a good snapshot. It's good for 6 months. Although this says home, again, that's the same rule that CDBG would be followed in the state of Pennsylvania as well. So some people ask me, you know, maybe those that work for housing authorities are so used to Section 8 that if they have any income changes or any household any household composition changes, that you do income eligibility again. That is not a rule that home follows, so you do not need to worry about that. It's just on an annual basis, you're going to be requalifying the household. Okay, so wanted to make sure that we covered kind of step 2, and then step 3 is we're going to have that calculation, which again, that's the majority of our training. We'll talk about the calculation of income. You're going to have that calculation. You're going to compare it against the income limits. And as I mentioned, the new ones for 2020 will be out on July 1st, and they're all done by geographic area, household size, and then I do have a little bit of information here about larger households. I will be able to, I'm not sure if I can do it at the end of this session or not. I may have to start the next session for Part 5 and IRS with this, but I want to show you the CPD income calculator. We do the larger household income limit calculations for HUD, and they're built into the calculator. So if you don't want to calculate the larger household limit, then use the calculator. That can be a huge time saver. So documenting the files, I have a whole section on this in session 5, but you're obviously going to make sure that you've got the application, number of household members, and other eligibility criteria, your backup documentation, written agreement with the household, or if it's rental, it would be the lease, all of those things. Okay, so I'm going to go back to Mentimeter. I want to make sure that there aren't any questions in the queue while I grab Mentimeter. Do I have any questions in the queue?
I don't believe there's any questions, Shauna. I think it's more so people did not receive the materials.
Okay. Okay. So in terms of that, I'm sure Chantel's able to individually email those out. Does that make sense?
Yes, I resent the materials out to those people that stated so.
Okay, great. All right. I'm actually going to relaunch Mentimeter because I really do want to make sure that we grab what your experience has been. So if you'll go ahead and grab your phones, I'm going to ask like a couple of questions so that you can give me some feedback. I'd like to know more about you, and this would help me do that. So we really want to know, like, how much experience do you have with income eligibility? So I want to make sure that, I may have some of you that can recite the Part 5 definition in your sleep, like I can, or maybe you just need a little bit of extra support, or you've got questions. You might be good, but you might need help with documentation. And then some of you might be what are definitions. So it seems like neck and neck right now is those of you that are good but need help with documentation, and then there are some of you that are saying what definitions. So so in terms of the definitions, again, we're going to talk about those next week, but I am rest assured that's why we have them as a standalone session, so we can really unpack Part 5, we can really unpack IRS, because they are fundamentally different. And I would say that those of you that are in the what are the definitions, I bet you, because 90% of grantees out there are using the Part 5 or Section 8 definition, where you talk a lot about like what assets that you have, you look at the income from the assets, you're using gross amount of Social Security, gross amount of wages. Only if you're looking at sort of taxable amounts is usually when you're using the IRS definition. So I see that definition used more likely in home buyer or owner-occupied rehabilitation. I also have a good comparison chart in the PowerPoint deck that I can show you that, that demonstrates sort of primary differences. So we're still neck and neck here. Okay, so this means that you guys are in the right place, and that we need to spend a lot of time on documentation and then the definitions, which I think we're planning to do. So this is really helpful. Okay. All right, so I'm going to attempt to go on to the next question. It really doesn't like that, does it? All right, we have a workaround. We will just go back and launch individual questions. Usually you can just advance. I don't know if it's because I'm showing my video that it's slowing it down, Chantel. We can look at it before the next meeting. So I also am very interested in knowing which programs you're working on, because I want to make sure that if a lot of you are doing like homeowner rehabilitation, which is showing up on the donut so far, I will use that as examples, as opposed to maybe only a handful of you are doing tenant-based rental assistance. So I'm really interested just to make sure that we find out like what kind of, I believe I've set the setting for this question for you to pick more than one. So make sure that you go back in and pick more than one, because some of you might be doing both a home buyer program and some of you might be doing homeowner rehabilitation. So please provide the response, and that we will take a look at it. I mean, it would be no surprise to me. Ohio, the state that I live in, as it was mentioned earlier, is similar to Pennsylvania. We have a lot of need for homeowner rehabilitation. The state of Ohio has a pretty robust homeowner rehabilitation program. We have a lot of needs in that area. So if that ends up being sort of the winner here, then there would be no surprise there. No surprise. Those of you doing rental, this is just a kind of a heads up. I am certified as a tax credit compliance professional, but we are not going to be trying to teach home and tax credits. I'm fine if you want to bring it up something in the office hours, and I'm happy to, you know, try to provide an answer to you. But this training primarily will be done on the HUD Part 5 definition, and not tax credits, which also uses Part 5. So, okay. Okay, great. And I can point you to some additional resources and things like that. All right, so most of you have told me homeowner rehabilitation, which sounds to me like you're trying to rehab the homeowner. I sometimes will use the term owner-occupied rehabilitation. All right, and then it's equally split between rental and home buyer, and then some of you are doing tenant-based rental assistance. Okay. All right, so I have one more question. And, you know, this also will help me as your trainer here. I would like to make sure that, that you tell me what are the hardest income or asset sources to document. And this one is, I've got to allow the results to be able to be provided. 1 second. I don't know why I have hide results. Okay, great. All right, so no surprise here. Okay, self-employment, that's going to be a good one. So we can talk about that extensively, and I have a slide on that. Unemployment, I'm also seeing that. That is something that we can discuss. I have a special slide about COVID, but we will talk about unemployment. We will also talk about seasonal workers. I mean, just like here we have, you know, folks that might be doing some work that is in the construction trades where it's only a certain part of the year. Maybe they have unemployment for the other part of the year. A couple of you have mentioned sort of a few one-offs here. Stocks, I saw annuities. Definitely, we're going to talk about inconsistent pay. I mean, people work any variety of hours, so we'll talk about that. A few people mentioned stocks, investments, and things like that. So at least one of you also mentioned Uber or Lyft. We know that that has become, you know, one of the side jobs that people have, or primary jobs. It's to help them, a lot of people survive. So we'll talk about that as well. Okay, this is really helpful. This is really helpful feedback. Okay, and reverse mortgages, don't let me forget about that one. That is not on one of my slides, but I'm happy to talk about that. Multiple jobs in a year. Okay. Initial Social Security award, arrears, unemployment, temp work. Okay. All right, this is really helpful. That'll be open on your side, so you can continue to like add, and then we'll go back to it. And one thing I should have mentioned is the results of the Mentimeter will also give DCED an idea of things that they might want to provide some clarifications on, or we can clarify as part of this, training series. So I'll keep it open, and you just, populate with things that you think about. So we're going to talk about determining income in the next few slides. Okay. So I do think, as I mentioned before, your application is incredibly important. Your application is going to provide information about who is either currently living in the household, so for example, owner-occupied rehabilitation, or if it's home buyer, who will live in the household. Okay, so we have to have applications that kind of fit multiple scenarios. Okay. So when we talk about applicant, like who lives in the household and who we're going to count, we're looking at all adults who will live in the household, okay? They're the ones who make income, and they're the ones who are going to, that we're focused on. And when I mentioned your application should have those that are age 18 years of age and older, that is who we're talking about. Now, there is a slight difference in the Part 5 definition that includes unearned income of minors, but we'll talk about that extensively next week. But primarily for this, we're talking about all of the adults who would be counted in both Part 5 as well as the IRS definition. So we're looking at those that are related. So they're related because by blood, marriage, adoption, et cetera. We also are looking at unrelated household members. So it may be those that folks that haven't gotten married, okay, or folks that are in a roommate situation. And we'll also talk on the next slide about who is considered a temporarily absent household member. They are included as household members and should be on the application. And then finally, it says family here. So I just want you to walk away with, I would encourage you guys to, even though it is in the home regulations, the word family, it's definitely in the CDBG regulations. But when we're talking about housing, and this is housing right now, with the exception of, I do have a slide on economic development assistance, we're really looking at who is in the household. And so I just want to make sure that, and encourage you guys to have applications that ask about who's in the household and not relying upon family, because family, to many of our clients I found over the years, they really think it's those that are related to them, again, by blood or marriage, okay, and not those that are currently living in. So you could miss some people that, that are considered household members. So you might have somebody who's applying for a home buyer program, and you, because of the way your application is structured, maybe it doesn't say anything about whether or not they would be living with a significant other once they have purchased the unit and they're going to live there. So if they have a significant other, because they will occupy the property, you need to include them on your application. Okay, so that was who do I count? And then we have a slide here that reminds us that we are not counting foster children, and we are also not counting, and I don't know if Pennsylvania has this, but I work across the country, and I do have clients in New Jersey. They have something called legal kinship, where they're guardians for others. We are also not counting foster adults as household members. That is something that is different from some of the other HUD programs. Home has not caught up with everything that HUD has decided to use in terms of who's in the household. So currently we're not counting foster adults. That could change in the future. And then it's been a long-standing exclusion. We don't count live-in aides, those that kind of help people with their activities of daily living. If I've got a rental project and those folks have special needs, we want to make sure that we're not counting those that happen to have a live-in aide or children of a live-in aide. And I don't think I have a slide on this, but typically live-in aides are paid. And there is a good definition of a live-in aide that we can take a look at. So you're not going to count them as a household member. So that means you're not going to count their income or any of the benefits that they receive for that particular individual. It is up to the program administrator whether or not you want to count unborn children or not. So you as the grantee can decide. So I recommend that you decide if you're going to count them. And if you are going to count them, then you should add a question to your application that says, do you expect your household composition to change over the next 12 months? And so that means that, and this can help you with whether or not somebody is living with their fiance or whomever, or will live with their fiance. So it kind of helps with unborn children. It helps with, folks that haven't told you who's living in the household. That question can be really, really helpful. So it is a recent change to some of the HUD guidance. I have the technical guide here. There is an old technical guide from 2005 that I have in the resource section for this particular training. There are some good things with that old guide, some good third-party forms, but it's not wholesale, can be used because a lot has happened since 2005. So we'll talk about that in a little bit more detail. And then finally, probably one of the more common questions that I get is whether or not shared custody of children and what we typically look for. It used to be that we had to do a lot of, not background checking, but just, we had to read the separation agreement or the divorce decree. We had to figure this out. So there's a couple ways to document shared custody. But typically these days, anyone who is going through some sort of custody battle, this is the most common, where we see either 100% goes to one parent or we find the shared custody, so 50% of the time. So some people will say, well, Shauna, what if they go to school in one district but not another? So long as something says that it's shared custody, we assume it's 50-50. That means that the household that you're serving can include them as a household member. Okay, so this particular slide talks about two different categories of household members, and this leans heavily on the Part 5 definition. So we have two categories here. The first category is the temporarily absent, but we're still counting them as household members, okay? So it might be that somebody is a seasonal worker, so maybe they're picking, strawberries, and they're in another state and they're going to return to Pennsylvania, okay? Another, pretty common example is somebody who's active military. So they're active military, they're overseas, or they are working elsewhere on a base, maybe outside of Pennsylvania, but they're going to return to the household. Those are the two most common in terms of temporarily absent. In terms of permanently absent, we have some folks that may be nursing home residents, okay? So we know any situation is common with nursing homes. Sometimes people, and we know this also from COVID, where they might be going from a hospital and then having some rehab for 2 weeks to a month to longer. The household decides to include them or not. It's really up to the head of household. They decide whether or not they are a household member. And if they are, then all the income and asset sources for that nursing home resident would be counted in terms of household composition, also household income. And then we have a few things to talk about related to students, but it is a common scenario where students are temporarily away from the home, they're at school, and then the household gets to decide if they want to include them or not, okay? Every situation can be a little bit different. And this is one of those that, there's only so much guidance in the TA manual that you really should go beyond that and, define for yourself. I mean, the key is to make sure everyone is treated fairly and consistently, and that you have policies in place to make sure that that everyone who walks in your door and that you're doing intake with your clients, that they're all being treated the same, and that you are clear about who's included and who's not, okay? So depending upon, the clients that you're serving, there are a lot of different types of households. Not everyone is, the old nuclear family, okay? So we do have multiple generations living together these days. There's a reason why there are the 9 to 12 person household limits that are available. So we have some larger families that make up multiple generations. So it could be that grandparents are living in or a grandmother is living in. So we want to, keep an eye out for those folks and include them and make sure that they're counted on the application. Last thing you want to do is have Bob the rehab guy go out and do an inspection for owner-occupied rehabilitation and find out that grandma lives in and she's not on the application because either maybe you had a poor application that didn't ask about our household members, or maybe your procedures or your application process wasn't clear that we're really looking at the full household composition. Now, I mentioned fiance. I mean, it could be, any two people cohabitating. So basically, you want to make sure that you're capturing these relationships on the application, or you document that they live elsewhere. So I know it's really hard if you don't have a relationship, like with one of the parties. So let's say you're working with the boyfriend and his girlfriend keeps coming to all of the, application and things like that, but she's not on the application. You need to try to document that they live elsewhere. They have another lease somewhere, or they have utility bills for another place as well. All of that would be really helpful. And all you're trying to do is your due diligence to make sure that you're documenting who lives in and who doesn't. So couples that have separated or divorced, and I'm sorry, I did not look this up before today. I apologize about whether or not Pennsylvania has separation agreements, but depending upon your state, you may have a separation agreement or a divorce decree. Because we have folks come in, to our program all the time where they say, well, we're divorced or we're separated. So the same thing, just document that they live somewhere else, okay? And this is about income eligibility. I understand, again, most of you are doing owner-occupied rehabilitation, and I understand that it is difficult when it comes to like heirs to properties or those that are owned with still that other party. That's an ownership issue that we can talk about separately in terms of your program design and about getting clearances for work that's done on the property. But for income eligibility, we're solely focused on those that live in the unit and those that do not live in the unit, at least for this particular scenario. And then finally, this says if somebody happens to be deceased who was a household member, I mean, this is, recommending that you could have a death certificate in the file. That is not a hard and fast rule at all. I was prepping for this and realized that was one of the things that HUD really wanted us to focus on, but we know that can be exceedingly difficult. And again, COVID aside, which we'll talk about documentation here shortly, but whatever your process is, just make sure, again, you're applying it across the board, because we don't want to find out that somebody wasn't counted who should be counted, okay? All right, so I'm going to pause here and see if we have any questions in the queue that we should take, and also right before we roll into a 10-minute break, because we have some other things that we should talk about related to students next and some calculations. So do we have any questions in the queue?
Hi, Shauna. Yes, we do. I need to scroll.
Okay, great.
Well, it's not scrolling for me for some reason. So let me start at the bottom. Is there a definition of short time incarceration?
Oh, and that's back on the slide that I showed. So no, there is not a definition in terms of somebody that might be incarcerated and they're temporarily absent. So you do income eligibility once a year. So I would say that if it's less than a year, more than a year, they're probably not earning any income. So you could exclude them as a household member, but there's no hard and fast. Those were examples.
Okay. And then what about 18 years of age who are still in secondary school with part-time jobs?
So we will talk about students and who constitutes a student. They're over the age of 18, so it'll depend on the definition of income. So they're counted as a household member if they live in the home. And in Part 5, we would look at their job, and we would only count the first $480 of their income. But if it's not the Part 5 definition, then we would look at the taxable amount of their income underneath the IRS definition. So a student somewhat depends, but they are counted as a household member. It's just how do you treat their income that they receive?
Okay. And I thought I saw one earlier. Please repeat April 30th to December 31st matter. I think that was going back to the waiver, perhaps.
Yes, it is going back to the waiver. Thank you. I'll get to that slide. Thank you. I did not mean to do that one quickly. So let me just get to that slide. Okay. Thanks for asking that question, whomever that is. So can you guys see my slide okay? Okay. So and this is a COVID-specific waiver. So for any new rental or tenant-based rental assistance clients, source documentation is not required. So I mentioned before you could do some type of virtual application or something like that. That would be acceptable. And it's April 30th through December 31st, 2020. So these are new applicants. You do not need to have source documentation that's actually collected. That was part of the waivers that came out a couple weeks ago from the Home Office.
Okay, great. I think that also covers one about asking for clarification on the waiver. And we have one more question. Live-in aides, family/household member or fiance. I'm not sure what that means. Maybe does it mean, what about if the live-in aide is a family household member or their fiance?
Well, this is what I think they're getting at, and I'm just going to triple check that I included this in the TA manual underneath the definitions. So what I often get is like a common question, Kimberly, is they want to know, what if it's a family member?
Yes.
Member, don't you think, like, consider the live-in aide? And it's typically not a family member. A live-in aide typically is somebody who is paid, and also it is somebody who, like, they literally help them with every single, like, their activities of daily living. Like, they help them, like, live independently. So typically it's not a relative. But thanks for that question. And I can see it now, Christina. So I'm good.
Yes.
As well. Okay,
great. You're all caught up. Thank you, Shauna.
Absolutely. Okay, so let's go ahead and take a 10-minute break and come back at 3 o'clock, and we'll keep going with the material. And I'll fix my Mentimeter. Okay, well, welcome back, everyone. Hopefully you had a great break. I do see there's a couple other questions in the chat, our chat box, on a few other things that came in. So I wanted to see if I could, I want to go back to live-in aides, want to make sure that, that we go back to the definition of live-in aide. So just a second. So I went back to kind of an older resource for us, and we can use some of it for the home program and for CDBG, but this is the definition of live-in aide. So it's a person who resides with one or more elderly persons, near elderly, or persons with disabilities. So they are there for the essential care of the person. They're not obligated for the support of the person. This typically is what takes into consideration, like, this is typically not a family member because family members also monetarily support. And then this one too would not be living in the unit except for to provide necessary support services. I do reference, this is 4350.3, which is used for HUD multifamily. It's where we can borrow some guidance. So the definition of live-in aid, we can borrow from that, and that should be helpful. So I'm going to stop sharing my screen. So hopefully that helps on live-in aid. And then another note came in on ADUs. So ADUs in my mind, and hopefully somebody from DCED can confirm that that's accessory dwelling units. So it is a separate unit that's on the property that they might rent to, another household or something like that. So I would say that if there is not rehabilitation going on with the accessory dwelling unit, then you would not include them as a household member. If the ADU is having rehabilitation or something like that, or you're assisting it in some way, then they would need to be income eligible. So hopefully that helps. And then I thought there was one more question in the chat, but maybe not. Is there any other question that has come in before I go through the rest of the material for today? Okay. All right. We will continue. The person that just wrote in, we might need to do a little bit more chatting back and forth, but I see you have a question and we may need to provide a more detailed answer. Okay. Okay. So in terms of, this is for students, and this is not a student that lives in an income eligible household. This is for units that are comprised of students only. And this is a home-only requirement. So this rule is for units that are comprised of entirely of students where they're under the age of 24, and basically they are not low-income households unless they qualify for one of these exemptions. And the reason for this, and this clarification that came out with the most recent home final rule, is that there were communities across the country that had home-assisted units that had students living there. And as we know, there is a shortage of affordable housing out there, and to have units that are comprised solely of students, was something that we felt like was, or HUD felt like that it was just inappropriate and not the best use of our funds. So they clarified that a low-income household could not be a unit comprised of students under the age of 24 unless they were an income-eligible household by themselves and they were completely independent. Exceptions for veteran households, they're married, which includes same-sex, or has a dependent child, okay? This final thing about disabled and was receiving Section 8, I mean, we're beyond 2005. That was a long time ago, so they're no longer 24, so it doesn't matter. So this is for any, I gave the example of rental, but this could be any home-assisted household. So this could be owner-occupied rehabilitation or even home buyer. They just have to meet one of the exceptions. And if they don't, then you can't serve them in your program. If you happen to have it's been 6 years or 7 years almost, sorry, since the home final rule came out. Maybe you haven't done income eligibility, although you probably have. But if you do happen to be in this boat where you've got in-place tenants, you basically need to treat them as members of other households, like find out what their income eligibility is of the household in which they are a member if they weren't living at school. So maybe it's their home, like their parents at home, things like that. And then you will need to look at, there probably will be over income, because if you have units comprised solely of students and then you're adding in their parents' income to every single student, they're probably over income. And there's a whole process for dealing with over income tenants. You probably are not in this boat, but I would make sure that you keep an eye out for students. There is a student form that we put in the back of the TA manual because we've been waiting for one to come out from HUD and we haven't been able to have one yet, but we really felt like you guys needed something to use in your program. So use the student form as necessary. Okay, so in terms of economic development, I mentioned that this was primarily a housing training. However, we did think that there was a couple things that you may want to be apprised of, and there will be some additional guidance coming out. So if you are operating economic development and you have a microenterprise assistant, and they are for low and moderate income, like business owners, okay? So if it is for an LMI business owner, then DCED is requiring that you do the full income eligibility that we're going to talk about for the rest of this training series. And it'll depend on whether or not the business owner is an individual or whether or not that LMI business owner has a family. So you'd be looking at either individual income eligibility or family in terms of income. This is a little bit different than the whole household discussion that we had earlier. This is the one exception. Now, if you happen to have ED loans or other sort of micro enterprise, this is for businesses that they're not, the owner is not low income. So in that case, a self-certification is fine, and there will be a self-certification form provided by DCED in the future. And this is where, like, the office manager at the business would be working to make sure that he or she is working with the folks where jobs were created or retained, that they represent at least 51% of the beneficiaries. We're not going to talk about self-certs for these ED loans or micro enterprises, and stay tuned because there'll be more coming out from DCED. So in terms of verification, a couple of things that we need to keep in mind as you design your program or enhance your program through this training. So we need at least 2 months of income sources, and that has to be from a real source. So it has to be like the actual pay stubs, Social Security letter. It has to be like from the actual source. That's different than third party. So third party, I mentioned one earlier, was verification of employment. Third party could also be a form that is sent to the unemployment office or child support enforcement. So third party are okay, but you must, for income sources, include 2 months of pay stubs, for example, okay? Or they can be duplicated so long as you can tell the story. So some of you like a verification of employment. I like it. It provides me with a year-long information about that person's job. And I also like pay stubs because pay stubs are for a short period of time and may not include bonuses or different pay differentials that you may see if you had a verification of employment. So sometimes I like to use both. It's completely up to you how you want to run your program, but you have to make sure you have the 2 months of source documentation. And then we get this question a lot. I really like tax returns. I think tax returns are very helpful. And tax returns can be useful in the 1040 definition. But we need to make sure that if you're using a tax return as like the copy, like the documentation, that it's the same circumstances are occurring. So we have to project forward for 12 months. If it's been, longer than 12 months since that income was earned, then it's going to be difficult to use that tax return. So we're in the middle of, 2020. How current is the FY2019 tax return? So it can be used for a period of time. I would like to see it sort of earlier in the year because it's, again, closer to when the income was actually earned. Some people like to get actual tax returns. Sometimes people like to get a transcript, which is the 4506T is a transcript. And you can also request for an actual copy from the IRS. There is a fee associated with it, which is the 4506. Some people like to use that. So in terms of COVID, in terms of verification of income, so we mentioned that self-certifications are okay. Again, that April 30th through December, and it is for new rental and new tenant-based rental assistance. If it's existing rental, typically those owners out there, and if you're an owner of a rental project, you are automatically not requiring source documentation because you don't have to do that for most of the home rental projects out there. But it also applies to those that have lost unemployment or income because of COVID. So it is not a self-certification that I've typically seen. This is a little bit different. It's not that here's my household income, here are my household members, and I'm self-certifying to my income. This is like a basic virtual application. So you could probably use your current application, you just wouldn't collect the documentation. And you have to convey the source and type of income source. You should specify if there's any special unemployment or other special assistance that is coming because of COVID for both a transparency point of view, but also folks are looking into making sure there's no duplication of any type of benefit. And then you do have to do income reviews within 90 days of the waiver period. So that means within 90 days of December 31st. Now, HUD has issued waivers in the past. They've also extended waivers. I'm sure DCED will ask for extended waivers if this continues, since we're unsure where we are in the pandemic. So I think tax returns are useful for establishing household composition and also the number of dependents. It's not always a fail-safe for that, but it can be helpful. I also think it's helpful for self-employment income. So several of you mentioned self-employment earlier. You could look at a couple years of tax returns and take an average of that income from a business, net income from a business, maybe a good number for you to use for either the Part 5 or the 1040 definition. And then I also like tax returns because they sometimes identify sources of income that I haven't seen before. Some construction workers, for example, may work for several construction companies, and I'm able to look at a tax return and see that that not everything has been included. It's not matching my pay stub. So it can be helpful for that as well. For self-employed individuals, several years of tax returns is helpful, and you want to make sure you kind of take into consideration fluctuations in income. Some of this is going to be garbage to some of you because of COVID. You know, a lot of businesses, unfortunately, are not doing very well right now. So you have to kind of gauge, you know, whether or not the business is currently operating and whether or not you should be looking at older information. There is, like I said, there's some third-party forms. There's also a net income from a business form that I included in the TA manual that can be really helpful to you that's used in the home program. So some businesses, depending upon what they are, folks take income out and give themselves, like they pay themselves. So you have to look at separately the net income for a business and then whether or not they pay themselves separately, and both should be included if that is how they're operating. There's too many businesses to keep in mind. So third party I mentioned are good from employers. Some people like them because they're completely independent and they provide you with what a third party is providing in terms of income. So verification of employment can give you, if you're working with somebody in the food service industry and tips are reported through the employer, then that would be a good indication. They could tell you about tips. They could tell you about bonuses. It might be that there are different types of pay. I know in medical jobs, there are different pay differentials, whether or not you work, third shift. Sometimes you make holiday pay. Now there's something that is hazard pay that some medical folks are earning that may be different. So you kind of want to look at, different sources, and on the pay stubs that you're looking at, it may not include everything. So you may want to do a third party for that reason. So completely up to you. This gives you sort of a format or a process for third party. So you have to have a written release in the household that says that you need to contact businesses on their behalf. They have to sign off that that's okay. And then you would send a verification form via fax or hard copy. Typically follow up if somebody's not responsive, and then make notes in the file depending upon what you've heard. Now, not everyone uses will respond to third party. I apologize. So what I have found is a couple of resources that could be helpful. So I don't know if there are any like housing authorities who are on this training, but housing authorities, and if you're a HUD multifamily project owner, may have access to the Enterprise Income Verification System, or EIV. And basically, this is a system that was started to automate a HUD form called the 50058. And so you can, if you have access to it, you could get some information from EIV. It's not supposed to be sole documentation, but there could be information there that could be helpful. I think what is probably more promising is the worknumber.com. So this is used by large retailers like Walmart, Cabela's, my father's favorite place on earth is Cabela's. You guys have a lot of Cabela's in Pennsylvania. They use the worknumber.com. Now, the worknumber.com they do charge a fee, but if you're a nonprofit, you might be able to get the fee reduced or something like that. I'd heard that there was a small fee now for nonprofits. So the work number can be helpful to you. I have heard some feedback about the work number about it being a little bit out of date and not current. So just tread carefully. But I'm just going to say, like, if you've done you want to do third party, some large retailers won't do that. They'll say they use the work number. So I always include that in all my trainings, just as sort of something to be aware of in case you get that kind of feedback. So I'm going to pause there because that was, we did more household composition. We did common sources of income. And then I was going to get into more like calculation type slides. So I just want to pause here and make sure that there are not any questions in the queue related to the common sources of income before we move forward. So do we have, sorry, I had to pause for a second.
There is, Shauna, a question about calculating income. Do we use straight hourly calculation or an average number of hours over 8 weeks / 2 months? But I believe you might be getting ready to get into that more now.
I am going to get in more to that now. So
okay.
Thank you.
And then, must self-certifications be notarized?
There is no hard and fast rule about notarized self-certifications. I think it depends upon what you would like to do as a program administrator. I would say that, well, amid COVID, that's one thing, but as a normal standard of business, do you have somebody who's a notary in your office? I mean, if not, then I probably wouldn't make things more difficult to serve your people. But if you do have a notary there and it can be done, it kind of adds credence or adds a certain level of, approval that somebody is saying that notary is like, I am the person who is doing this and I'm doing it in a notarized format. So it can be helpful, but I wouldn't fall on a sword for it and make it a requirement.
I think it should also be just reiterated where self-certifications are allowed to be used, and that is only for a certain period of time to the end of this year, and that it's also been stated by HUD that in the use of any self-certifications, we still have the responsibility to go back and do an income verification when it's allowed. The self-certifications were part of the waiver in order to allow because of COVID. But now that things are back up and running, we are to do income verifications when and where we can.
Okay, thanks for the clarification. I feel like there's the self-certification because of COVID, and then also if somebody is in rental, and again, I'm not sure how many folks on the phone. I think the last time I looked at the donut, there was a few, maybe 10 or so were doing rental. 20-some people were doing rental housing. There is a self-certification, and I'm going to go into that in the final session, but you have to do source documentation every 6th year of the period of affordability. So initial occupancy every 6th year of the period of affordability. And that self-cert is what I was describing earlier, which is here's my size, and here I'm self-certifying my income is below a certain level. Different from the COVID self-certification, which again is like a virtual application. So there's different self-certs that people are talking about, but just know there are two different things kind of going on. I was surprised that HUD used the word self-certification, and I thought they were talking about a more basic form. And more recently, when I realized that no, they're actually talking about collecting information about all their income and asset sources for households. So, but we'll talk about that. COVID is one thing. Self-certifications over the period of affordability for rental or something else, which is basically what Kimberly's point is.
There's a comment about ask her about the year-to-date total of income average.
Okay. And then there was one more that I wanted to get my head around.
Oh, the one about student? The student rule?
No, it was one about the third party. So somebody asked if we have third-party verification of monies to be received in the current year of intake. Do we still need 2 months of funds received? So this is one thing that I am not sure why HUD decided to make the 2 months required. I would say you still have to collect the 2 months of source documentation, but if you've got third party that is better, that gives you a fuller picture of that household, you can certainly use that.
Okay. An applicant filled out a self-cert and it put her over income. Then she said it cannot be used since it was not notarized. So I just wondered your thoughts. So that was just in response to the self-certification question about needing to be notarized. Okay. You're caught up. Thank you.
Yeah, of course. All right, sounds good. And then those of you that ask more about calculation questions, this will be your place to really kind of take a look at that. We will continue to talk about your other questions. We won't forget about those, and we will be able to handle additional ones as we walk through. So you have a couple of options. The person who wrote the year-to-date and sort of looking at the average. So some of you like to look at a year-to-date and use that to project forward. So you can certainly do that. I like to use things that are more forward-looking than backward-looking, because year-to-date is still looking backward. And because so many of our jobs have changed, our job situations have changed because of COVID, you may just want to look forward. So I like to use the current rate of pay multiplied by the number of hours that they worked, and then the number of weeks that they've worked in that year, okay? And we can average the number of hours if they sort of have fluctuating hours, but we're taking the gross rate of pay, like their wage rate, times the number of hours worked per week, multiplied by the number of weeks worked per year. I have colleagues who like to use quarterly pay, and some of you are probably raising your hands that you like quarterly pay. That's another option that you could take a look at, is maybe I could look at the last quarter and then project forward. Since we're almost to the end of the second quarter of the year and people have been working amongst COVID, that may be a good place to take a look at quarterly pay and then project forward. People like quarterly pay. Also, my friend who said they like year-to-date, probably because they don't want to have to figure out sort of the average number of hours worked per week. So if that's your preferred method, that works just fine. Quarterly pay or year-to-date, you can do that. I just would keep in mind that things have fluctuated. So one thing to keep in mind, whatever you do, is that look for increases in pay, look for cost of living adjustments, and make sure the calculation is appropriate, okay? And you should document whatever's in your procedures, like this is how we're going to calculate income, because you want to make sure that if anyone comes to monitor your files, HUD or DCED that they can see your pattern. I think most of the time when I've monitored files is I don't know how you've calculated it and I'm getting a different number. So it's very important that everyone calculates income the same way, which is why I'm going to spend some time on the income eligibility calculator either at the end of the session or next time to make sure that you know what's there and what's available to you. So my favorite methodology is I know they have a certain rate that they're being paid, and I know they're working 40 hours a week times 52. So their pay rate times 2080 is my favorite way, and it's also the quickest way I'm able to figure out if somebody's income eligible. So this just gives you an example of Mrs. Jones, $13 an hour. She works full time, and we multiply the 13 times 2080 to get 27,000. Okay. Now we do know that again, people are working sort of unsteady amounts. This slide has been part of our training for a long time, but now because of COVID, it may be sort of all over the place. Okay, some people are picking up hours sort of here and there. So it might be heavier one week than another. So what you could do is take the pay rate times the average number of hours, worked per week, and then multiply that times, in this case, it's 40 weeks, but let's say you want to project forward for the rest of the year, it could also be 52 weeks. So you decide based upon that, that situation where you've got unsteady pay. Again, they might work 30 hours a week, 40 hours a week, 50 hours, it's all over the place. You want to come up with that methodology. Unsteady pay, this is a good kind of rule of thumb. If you like quarterly pay, again, some of you like that, and that might be good at the end of the second quarter here, is that if you can get at the end of June, if you can get some type of quarterly pay or year to date that you can prorate forward for that household. So that might be helpful. So this is an example of quarterly pay that you just multiply, Mr. Jones's mother's pay stub. It shows that 5,000 is her quarterly pay amount year to date. Multiplied by 4, you get 20,000. Okay, so that's a methodology. So that's sort of like the calculation. If I've got gross wages, if I have the number of hours worked per week, but there's some other scenarios that could happen. So I mentioned that you need to add on bonuses. You need to know if there's a cost of living adjustment. All of those things aren't in detail on the slide, but when I go through the demo of the calculator, you'll see how easy it is to add in there. So I'll talk probably more about that then. But variations in pay. So, and folks have this in the Mentimeter, right? Like sort of uneven sources of pay, just again, varying amounts. So the first example that I have here is that I have noticed a pattern pre-COVID, but I may have seasonal workers where they work construction or they work landscaping for some months out of the year, and then the other part of the year, and I can see it based upon their tax return, that they earn unemployment. So before COVID, you would have, I'm going to add their seasonal income to their unemployment. And that way I'll get a full picture of 12 months of their pay. Okay? You want to add. What was not appropriate is to say, oh, today they're earning unemployment. I'm just going to assume that they're going to earn unemployment for 12 months, which, there are caps on unemployment, right? Again, pre-COVID. So that's why that's not appropriate, because you can't assume that they're going to do that when you have a pattern that you've seen in their tax return. However, because of where we are with COVID, I'm going to say that if this is a worker who does have unemployment because of COVID, that we probably need to count it for the foreseeable future. Okay, with one exception is that emergency unemployment does not count, and I have a slide on that. Okay. So in terms of documentation, if they're currently receiving unemployment minus the amount we're going to exclude for COVID, you can just assume they're going to receive that, and you could use a third-party form. You could also ask that they provide a printout from the unemployment office. that also would be, fine to use. And, the Office of Employment Compensation is something that they should easily be able to get a printout of their benefits and provide to you, okay? I often don't bother with third-party forms if I know somebody can get the information, again, when we're documenting. And then self-employment, I mentioned that the couple years tax returns could be helpful. I also have in the TA manual that you can use net income from a business form. And then there's also a couple of IRS pages that I can go over when we talk more about the IRS definition that can be helpful in terms of documentation. So one thing I found in terms of construction or seasonal employment is that they may work for more than one firm, okay? So this was particularly true when I worked in Bergen County, New Jersey, where they worked for the union and then they hired themselves out, like it was the painters union, then they worked for any number of different contractors from there. So a couple ways of doing that. You can certainly collect last year's W-2s as a part of looking at tax returns. You could also have them tell you on the application however many construction companies that they're working for. And then some people do choose as sort of a last documentation effort to use a verification of employment and just send it out to all those construction companies. And that when it comes back and says that Johnny doesn't work here anymore, then you've done your due diligence. But just be aware that not everyone has one job is my message. They may have multiple jobs and you want to collect that information, or they might be, working seasonally and you can see a pattern. The example I used about cash contributions, we see this in rental housing or tenant-based rental assistance a lot. Some of you that have known me for a long time know that my sister's disabled and my parents paid for 1/2 of her rent for years. She could not get Section 8 rental assistance in the town that I'm from in Indiana. So we know other people, either because they have a cash business or because they have somebody who's helping them, like my sister's example. There is a cash verification form that you can use that we link to in the TA manual that could be really helpful. I also recommend, and this would be for Uber, Lyft, some of the folks that brought up that, so a couple of options for those folks. It's my understanding that, I know Lyft does this and Uber should do this as well, is that the folks that work for them get a 1099. And when they get a 1099, you should be able to see the income for the household and use that. Others may not have a 1099 that's current. Again, it's been a little bit since last year. You may need to look at periodic deposits in checking and savings account for those that work for Uber, Lyft, DoorDash, et cetera, okay? So I always look at checking and savings account statements, and if I see periodic deposits, then I might ask, what is this for, and just make sure that you're documenting it. I know we all want to do the right thing by our clients, and not everyone is, again, working sort of like a set job these days, so we need to be open to these kind of separate businesses that they might be operating or additional income, because everyone needs a lot of help these days, but we got to document it appropriately. Okay, then finally, zero income for a household member. So I know one of you brought it up on the Mentimeter. Thank you so much, whoever did that. This is probably the #1 question that we get. So a couple different things. So it could be zero income for the entire household. That could be because somebody's formerly homeless and is not earning any money currently, and they receive other benefits. So tenant-based rental assistance, or it might be a rental project that's serving those that are formerly homeless. We might see for an entire household that no one is earning any income, okay? And they'll say, I make no money. So that's the more common scenario, or one of the common scenarios. The other common scenario is I'm helping somebody, maybe I'm serving my client through owner-occupied rehabilitation, and that client has a member of their household who simply doesn't work. So as part of your procedures, you need to document how you're going to handle either situation. So this kind of just gives you a roadmap. So In the case of, somebody who says they make no income, but you know that they're paying their rent, asking them how they're paying their rent, utilities, car payment, et cetera, like whatever they have. And often through just normal interview questions that I would encourage you, like these are the 5 questions we ask, again, to make sure you're treating everyone equally, you might reveal their other sources. You might reveal that, oh, somebody is paying my rent, or I'm receiving this assistance. I didn't think about including it on the application. This happens all the time. And if they do reveal those other sources, just treat them like you would the other verification. And then also you should decide as part of your process if you are going to use the 4506, which I said has a fee, or the 4506T to obtain a certified copy of their tax return, just a transcript of it, okay? So you can decide if you want to do that. Now, I know some folks have decided that they do want to go that route because it's for a household that they're serving maybe through home buyer or homeowner rehabilitation, and they just want to make sure that they're kind of, crossing all their I's and dotting their T's, okay? I probably would not go to that extent for somebody who's a formerly homeless person, okay? And then finally, you could do a self-certification form of zero income. There is one in the TA manual, but I would not use that as the sole source of income for the household. That would be extremely rare in case of that situation. Hopefully that helps a little bit with zero income. Again, it's more of like what is our policy about how we're going to document, and what are sort of the steps we're going to go through to make sure that we are documenting income eligibility correctly. So hopefully that helps the person who asked about zero income. I do want to cover a special slide on COVID. This is the most common question that we get. We also had a question about this after the Housing and Economic Recovery Act back in 2009, HERA. A bunch of folks received economic impact payments back then, and we were asked back then through that foreclosure crisis if that was counted as income. So the same thing applies today. The ones that we received this year because of COVID, that is not counted as an income source. It's a one-time payment. It's not considered to be an income source. We also clarified that the temporary enhancement of unemployment, the $600 that was provided through the CARES Act, is excluded from annual income, okay? And there could be more, okay? I know that there's been some movement for additional unemployment. And so I think so long as that continues and they consider it to be temporary, it's also going to be excluded. But for right now, that initial $600 is excluded. We are not counting that as an income source. And so I mentioned this before, and I thought I had this, is that your application should capture the amounts of these special COVID benefits and also the source. And it may not be specific to your purpose in terms of, maybe the CDBG program, but for home, we do want to know if anyone's receiving some sort of if there's home TBRA, somebody might be receiving a special voucher that has been provided. And we never want to duplicate home tenant-based rental assistance with another source. Like home TBRA and Section 8 duplicate each other. There could be other rental assistance that also duplicate. So there's not a lot of guidance for the home program in terms of duplication of benefits, but there is for CDBG, and there's going to be some additional guidance around that. But basically the idea is that you don't want to have more than one source pay for the same thing for this household, okay? Hopefully that helps. And I also would say, because we're doing some virtual applications, also known as self-certs, is that when you do have to do documentation, you have to have enough information to go back to the household to ask them, okay, you said that you were working this job or you're receiving this benefit. It helps you with that 90 days after December 31st, to go back and then capture those income and asset sources. Anyway, it makes sense. Hopefully that makes sense to you, and hopefully that's helpful. Okay. I'm going to ask, so we're about 3:45. What other questions do we have in the queue about documentation?
The only other question that's come in so far asks, what about overtime pay?
Okay. So overtime pay or any type of like pay differentials. So many different jobs have overtime pay. So I would encourage you all to get to know what income sources the folks that you're serving typically make, and then look for overtime, because overtime is counted in both definitions, and you want to make sure that you're capturing that. In the calculator, which I'll show you, there's a place to put in bonuses for each month or the amount of overtime for each month. Sometimes we see overtime around like holidays. So I would look for it around holidays. You could ask about it in a third-party form or as part of intake, but you would count it just like you would bonuses for various types of jobs. Other questions in the queue, and I can look there too. Those of you that asked about the slides, we're also emailing them out. So, and we emailed them out this morning from Chantel Key. You can look at it in your inbox. So, all right. So at least one person asked about those that may not include their self-employment on their tax returns. There is a lot of guidance on the IRS on the website about self-employment and to help businesses out. And the idea is that it's kind of to discourage cash businesses only. And I'm just going to put this out there that those that do need to file taxes and those that do need to make sure that they are, reporting to the federal government on that, you can make that a condition of your program, okay? So self-employed individuals typically still have to file their taxes. So I would want to see that they file them. No different than tips being counted and reported to the federal government. That's cash. I mean, they're really supposed to be reporting it to the federal government. So you can give them some IRS resources that may help, but you could also make it a condition of simply working in your program, no different than you must have, and many of you do this in your homeowner rehabilitation programs, where folks are current on their property taxes, that they have, insurance, hazard insurance on the bill, on their property. You can decide. So hopefully that helps a little bit there. I mean, if they're self-employed, they should still be filing taxes and still supporting, reporting to the federal government. Okay, direct deposit. Okay, so that's a great question. So what happens in a direct deposit situation? In a direct deposit situation, that is net pay. It's not going to be gross pay. No different than the Social Security as well. We cannot use a checking account deposit of Social Security because that's not the gross amount of Social Security. So the gross amount includes all benefits included, that type of thing, and that's what you're supposed to use for gross annual income. Net pay doesn't help you. I understand it's different. I said you could look at I said you could look at checking and savings accounts for folks like Uber and Lyft and et cetera when you can't get a 1099, but that's like the best you can do, if that makes sense, for those businesses. But for other like normal people who have like wages and things like that they're earning or Social Security, I would get the pay stubs and or the Social Security letter as gross. Okay, I'm looking to see if there are other questions. Yeah, okay. Okay. All right, so I have like 15 minutes, so unless I have any questions in the queue, I kind of would like to just at least share, because I want to make, I'm a completionist. We said we would briefly show you the income eligibility calculator, and so I think I'm just at least going to start orienting you, and then we'll see, I'll do this for about 10 minutes, and I'll see what kind of questions are in the queue, if that works for you, Kimberly.
Absolutely. Thank you, Shauna.
Great. So I work at a company called ICF, and we built this calculator on the HUD Exchange. And the idea was, there was one for home years ago on the HUD.gov site. We wanted to have a place here that could do more than just the home program. We wanted to include all these other programs. And so we built a calculator. So I'm on the landing page, and I got here by either typing into the hour or the magnifying glass up here and putting an income calculator, or because I have a HUD Exchange account and you have to have one in order to use the calculator, I went into my HUD Exchange here, and then I chose the calculator. So you can get to it any number of ways, but you do have to have an account. So this is the landing page. We include all the links to all the income limits here. There's also a user manual. A lot of help around like calculations for the calculator is in this user manual. So you want to take a look at that at the same time you go into the calculator. So a couple things. I mentioned that the income limits were coming out and they will be effective July 1st. And that's when it'll be updated in the calculator, but we always tell you on the landing page what is in effect today. So currently in the calculator, it's that. And then as we move forward to July 1st, it will be the 2020 income limits. So I could go down to home. I could also show CDBG, but I'm just going to go ahead and select a new calculation. And because I've been talking a lot about home, I should probably give folks that that like CDBG a little bit of a love here. So I chose CDBG, and you'll see this is annual income to the left-hand side. So I'm just going to choose housing, and I'm going to walk through a series of screens that we're going to basically get to know this household. We have a place to put in like generic information about the household, beneficiary ID, and then you choose the number of like household members, but you really come up with, your beneficiary ID yourself. And that's to protect the privacy on a site like this. So it's worked really well over the last decade since we built it. So I'm just going to go ahead on the beneficiary like ID screen here and talk about the members. This is going to ask us questions about who's the head of household, who's the co-head of household, and whether or not there's like a child under the age of 18. Some of these other questions have to do with adjusted income, so I'm not going to touch on those right this second. This page, this is all the same so far. It looks identical to home. You have the income limits here that you can go to. Opens up into a new window. We can go down here to Pennsylvania, and we can choose Pennsylvania, and we can choose. Let's see, I saw somebody from Pike County, so I'll choose Pike County, and then I can choose the various income limits here. So maybe it's an owner-occupied rehabilitation in Pike County. So you can print this page for your records. It will come out as a PDF, and you can just save it, and that might be really helpful to you to have it. So then it walks you through a series of questions. This one is sort of a sorter. If tax credits were involved, if this was a rental project, it would automatically default to Part 5. But I'm just going to select no here. And then I'm going to choose Part 5. I could choose IRS, but I'm just going to show Part 5 briefly because we'll talk about, again, what are the major differences next week. So there are two options here. One is the short form that is a quicker path to get you the calculation, or you could choose the guided. And I'm just going to show you the guided for a second, just because we have a lot of you that are very interested in like bonuses, things like that. And so I can just show you. So for beneficiary member A, I just put the person in. I'm not going to add a job, or sorry, I'm not going to add a asset, but I am going to add a job for this household member. And when I chose the job, instead of like, no, they don't have a job, yes, they have a job, this is where you could put in the type of, job that they have. You can choose hourly, you can choose annual. So this is where you can do a lot, like deeper dive, and this is the hourly wage, and then the average number of hours worked per week, weeks per year. And then those of you that asked about bonuses overtime, you can populate that. one thing that I think is really cool is this whole raises or cost of living adjustments. For both of these, it asks more information about it. So what is the new hourly wage, and then what date does it start? And then you could say, oh, I know that they're going to have this wage rate as of October 1st, and you could toggle over to October 1st. For cost of living adjustment, you would just provide a percentage for the cost of living adjustment and then provide the date on which, it starts. So for each household member, you can kind of walk through the mechanics here and provide, all the information about the particular household. I didn't point this out, but here are the Part 5 inclusions and exclusions. So basically, there is, a number of questions they're going to ask in the guided method, and it's going to do it for each household member. Some folks are less interested in the guided, and they want to do the short form. And when they do the short form, then they're going to, for each of these tabs, they're going to add assets and income for each of them. But it doesn't have a lot of the detail that, we talked about. It's not going to have the bonuses there or the COLA or the raises. And this is just the way we built the calculator. We are in the middle of doing some updates to it, so it could change. But basically that is, what it looks like for a CDBG housing activity. So I just want to make sure that I showed you that. Let's just make sure. I'm going to talk more about the calculator. We're going to add to this and talk about Part 5 and Section 8 next week, as well as the IRS definition. Oh, so I have the links here to the calculator, the user manual, and then it takes about 15 minutes to complete. And then I mentioned there is a PDF of the income limit page, but then you can also save your calculation, which I'll show you next week. You can save it to a PDF and then put that in your file, which may be helpful to you. Okay, so then I'm going to go ahead and for Mentimeter, I'm just going to make sure that I move on to the last question about whether or not this session 1 met your expectations. We'll be doing this at the end of every single session, so please let us know. And Kimberly, we have about 5 minutes left, according to my screen. Any other questions that have come in? And I know that was fast on the calculator, but again, you'll get to see it again, and we'll unpack it a little bit more next week.
It's a request. Can we get examples of how to word the additional questions that have been suggested to add to the application, such as COVID income, household changes, and the other suggestions that Sean has made on questions? So I think that's just a request, for some of that additional language. One of them, when I think back to today's presentation, was, making sure that everybody in the household is included.
Do you expect your household composition to change in the next 12 months?
Yes, yes. And I think some of those were actually covered. So, but yeah, we can work on that. But that's it. That's the only other comment or question so far, because prior to that you had answered. That was about direct deposit.
Okay, great. So just as a reminder, I'm just going to go back in my slides for a second. Again, you have all of the registration links for the next couple of weeks in the email that you received today from Chantel. We expect all of you to come next week to talk about gross annual income for Part 5 and IRS. That's session 2. Some of you, may decide you don't want to do the office hour with me. I'm not going to be offended, but we definitely would like to see you on June 23rd, and then at the end on July 1st to kind of wrap up the webinar series. If you're working in tenant-based rental assistance, we expect you next week for session 2. We expect you in session 4 on June 30th, and then finally in session 5. Because you really need to know not just gross annual income, we got to talk through adjusted income, and then also talk through tenant-based rental assistance, show some calculations on the calculator, make sure we're answering your questions. So depending upon your type of activity, you may be hearing from us over the next couple of weeks several times. All right. Well, if no other questions came in, Kimberly, I'll give you 3 minutes, maybe 2-3 minutes back into your day, and appreciate all of you sitting through this. And we'll talk to you next week. And be safe, everyone.
Thank you very much for attending.
Take care.
Take care.